$5 trillion. That's how much money vanished in the dot-com crash. Gone. In less than 2 years. In the mid-1990s, something extraordinary was happening. A new world was being born, not from steel and concrete, but from fiber optics and computer code. The internet promised to reshape everything, from the way we shop to the way we communicated with each other across continents. Investors, both professional and amateur, couldn't get enough of this new frontier. Companies with no revenue, no profit, and often no clear business model, but with a simple .com at the end of their name, saw their stock prices soar into the stratosphere. Pets.com became a household name, selling pet supplies online at a loss. Webvan promised grocery delivery to your door within 30 minutes. Boo.com spent millions on flashy advertising before selling a single item. These companies weren't just businesses, they were cultural phenomena. The fear of missing out, what we now call FOMO, was real and contagious. Your neighbor was getting rich. Your cousin quit his job to trade stocks. Everyone seemed to be making money except you. And that feeling, that desperate urge to join the party, would prove to be the most expensive emotion in financial history. By 1999, the Nasdaq Composite Index had risen over 500% in just 5 years. 500%. To put that in perspective, a $10,000 investment in 1995 would be worth $60,000 by the turn of the millennium. Professional investors called it irrational exuberance. The public called it freedom. Day traders quit their secure jobs to sit in front of multiple monitors in their home offices. Grandmothers compared stock tips at family dinners. Taxi drivers gave investment advice to passengers. The old rules of investing were declared dead by a new generation who believed they had rewritten the laws of economics. A new metric emerged to replace old-fashioned concepts like profit and revenue. It was called eyeballs. As long as people visited your website, your stock would go up. It didn't matter if you lost money on every transaction. It didn't matter if your business model made no sense. All that mattered was growth. The Federal Reserve, led by Chairman Alan Greenspan, grew concerned. In a famous speech, he used the phrase, irrational exuberance, to describe the market's behavior. The Fed tried to cool things down by raising interest rates. But the party had already become a frenzy. And as history teaches us, frenzies never end well. The reckoning came swiftly, like a storm that no one saw coming until the first lightning bolt struck. On March 10, 2000, the Nasdaq Composite Index peaked at 5,048 points. It was the highest level it would reach for nearly 16 years. And then, almost without warning, the sell-off began. What started as a modest decline quickly accelerated into a panic. Investors who had been euphoric just weeks earlier now rushed for the exits. The problem was that everyone was trying to sell at the same time. And when everyone sells and no one buys, prices don't just fall. They collapse. Within 2 years, the Nasdaq had lost nearly 80% of its value. $5 trillion in market value simply vanished. To understand that number, $5 trillion is more than the entire economy of Germany. It was the single largest destruction of wealth in stock market history. Pets.com went from $11 per share to zero in just 9 months. Webvan, which had raised over $800 million, declared bankruptcy. Boo.com burned through $135 million in 6 months before collapsing. Over 6,000 technology companies shut their doors forever. Silicon Valley, once the brightest star in America's economic galaxy, turned into a ghost town. Office parks that had been filled with young entrepreneurs now sat empty, their parking lots covered in weeds. The cranes that had built new headquarters were dismantled and moved away. Millions of ordinary people lost their retirement savings. Teachers, firefighters, nurses, people who had been told that investing in technology was safe, watched helplessly as their life savings evaporated. Some had bet everything on a single stock. Others had borrowed money to buy more shares at the peak. It took the Nasdaq over 15 years to reclaim its 2000 peak. An entire generation of investors learned to fear the stock market. The dot-com crash didn't just destroy companies, it broke trust in innovation for nearly a decade. Every new technology was viewed with suspicion. Every startup founder was assumed to be a con artist. But from the ashes of the crash, something unexpected emerged. The surviving companies, the ones with real business models and real profits, became stronger. And in the chaos of the collapse, two young entrepreneurs named Larry Page and Sergey Brin were quietly building something called Google. Amazon survived. Jeff Bezos had spent the late 1990s reinvesting every dollar into warehouses and logistics rather than chasing short-term stock gains. When the crash came, Amazon had real assets and a real plan. Today, it's one of the most valuable companies in the world. Google was born in the chaos of the crash. While other companies were burning cash on Super Bowl commercials, Page and Brin were perfecting their search algorithm. They launched Google in 1998, survived the crash, and went public in 2004. The rest is history. The dot-com bubble teaches one lesson that every investor needs to hear. When the only thing propping up a stock price is the hope that someone else will pay more, you are not investing. You are gambling. The greater fool theory always ends the same way, with the last fool holding worthless paper. The tools change from tulips to railroads to internet stocks to cryptocurrencies. But the human heart remains the same. We are still driven by greed, by fear of missing out, and by the belief that this time is different. It never is. The only question is whether you will learn from history or repeat it.